Hey everybody, it is Patrick Moore with Ironclad Wealth Management here. And I've got a video today that I'm excited to share because it takes a couple of different concepts and merges them together, which is always when you get the best results when you're doing tax planning. And that's what I want to talk about, which is tax loss harvesting for small business owners, because it's something that people are aware of, but they're not always aware of exactly how you can use it to combine with some other events happening in your life. And I specifically think that small business owners can benefit from a solid tax loss harvesting strategy. So let's dive right in. Before we get in there, this is not individualized advice. What it is it's general information that definitely needs to be used in the context of your own financial and tax plan. Any strategy can sound good, but it needs to have context to what matters for you. Now, we're going to talk about two things today because I want to lay the groundwork by talking to you about how tax loss harvesting works. And then I also then want to move into that business owner specific example. So I kind of think tax loss harvesting has two main rules. The first are the investment rules, which mean that you first have to have a security that's at a loss, which you then sell and replace with a security that has similar characteristics. And I say similar, not identical, because when we move to the tax rules section, as you can see here in the middle, the main tax rule for tax loss harvesting is the wash sale rule. The wash sale rule says that you have a 61-day window. So in the middle, it's the day you sell the security that's at a loss. And then 30 days before and 30 days after, you can't have purchased what's considered a substantially identical security. The easiest example is if you have Apple at a loss, you can't sell Apple and then rebuy Apple, right? So if you look at my little table here at the bottom, you can see that in my example, we sell Apple and then we rebuy QQQ. So even though QQQ, which is the NASDAQ 100 ETF, is very similar to Apple, which you want because you want to have the same investment characteristics, it's not identical. And that means that you can realize the loss and hopefully your investment portfolio performs about the same. You wouldn't really want to sell Apple and then buy like Exxon because going from a technology to an oil stock is going to have a huge change on the investment outlook of your portfolio. Now, if you wanted to do that anyway, that'd be something you can do. There's no reason not to. It's just if you want to keep, like, for example, the same outlook for the long term and the same exposure to certain sectors, this would be one of the ways you can do it. Now, when you realize those losses, what can they be used for? Well, they can be used for two things. They can offset all other capital gains, and then up to $3,000 per year in ordinary income can be offset by your tax loss harvesting. So, just looking at a wash sale here, an example of it, let's say that in your 61-day window, you make a mistake and you buy a call option on Apple to replace Apple because you think you're being clever. Call options actually qualify, they're considered substantially identical. And another thing that happens is if you were to sell Apple and then rebuy it in an IRA, those losses are also considered substantially identical. And what happens is those losses are disallowed. So, what happens is that disallowed loss gets added back to your tax basis, which puts you in the same position you were in anyway. So you got to know the rules before you do this. And if you're going to do anything sophisticated like looking at convertible bonds, preferred stock, you definitely need to talk to a tax advisor before doing this. But really, it's very, in my opinion, easy to avoid. Just look at buying an ETF that's similar without being substantially identical. So finally, let's say you do this right. Well, what does it look like from a planning basis? So let's say in 2024, you have $100,000 in losses, but you also have $50,000 in gains. That results in a net $50,000 loss for the year. Like we talked about, not all of that can offset your ordinary income. And by ordinary income, I mean business income, W 2 income, things that you're actively earning, right? So only $3,000 of your ordinary income can be offset by your capital gains. And that's a good, well, it's a bad that it's limited, but it's a good thing that you can do it because what you're doing is you're taking capital gains, which have a 20% tax rate, and you're turning those losses into an ordinary loss, which has a 37% tax loss. So you're getting preferential tax treatment by being able to offset $3,000 of your ordinary income. But in this example, there's still $47,000 left. We don't know what's going to happen in 2025, but you can carry forward those $47,000 in losses. They don't just evaporate, they carry forward to 2025, and they do carry forward indefinitely. Now, when you pass away, they do go away. but it is something that you can benefit from for the foreseeable future. Now, as far as tax loss harvesting goes, there's two types of what I would call tax loss harvesting, and this is very much a kind of, I would say, personal distinction. You have what I would call the basic or general tax loss harvesting, which is I think, the way it started, right? You look up at the end of the year, you've sold a few stocks, and you're like, oh crap, I've got $100,000 in capital gains, and I'm going to owe $25,000 in taxes. And so what people will do is at the end of the year, they'll look at some individual stocks and they will sell them at a loss to try and offset those gains. Now that's how it started. But what happened is essentially sophisticated investment managers realized we can do this systematically. And this is what I call systematic tax loss harvesting. And this is the form that I think can benefit business owners today. What happens is systematic tax loss harvesting means that instead of just happening at the end of the year or like once a month when you check your account, there is a computer that has had a rule set written into it that's like, hey, here's the wash sale rules. Here are the investment characteristics of all the securities in our universe, and they trade them daily. If a stock goes at a loss, they will replace it pretty quickly with another stock that has similar investment characteristics. Sometimes this will be called direct indexing. So if you're familiar with direct indexing, this is kind of what I would call systematic tax loss harvesting. So as I just mentioned, let's just choose the Russell 3000. In this example, the Russell 3000 gets chosen, and then they buy 1,800 of the stocks. Random number I chose here, but it'll be pretty close. So they buy 60% of the index. And what will happen is, over the long term, if the index goes up 7%, their goal is to buy 1,800 stocks instead of one ETF. And those 1,800 stocks will hopefully be up 7% as well, because it tracks along very closely and they have the same characteristics as the broader index when you mash them all together. So if you look at that, what will happen is there's still 1,200 stocks left over. So when one of the 1,800 goes to a loss, the manager will sell the one of the 1,800, they'll pick one of the 1,200 out, invest in it to replace the one that was at a loss, and it should have similar investment characteristics. So at the end of the year, you wind up with hopefully a 7% gain, just like the index, but you wind up with a 7% gain while realizing some tax losses along the way and maybe getting that ordinary deduction of 3,000 years. Now, what will happen is typically over a 10 or 15 year period, these accounts will run out of losses. Because if you think about it, if 80% of the index is positive on the average year, you stack a few of those years together, then all of a sudden maybe only 4% of the account is at a loss. So over time, these strategies do, the easiest way to say it, they just run out of steam, right? And so when you hear about tax loss harvesting from places like Vanguard or Parametric, so real quick, it's just what we talked about. Choose an index, could be any index, buy positions that replicate the index, sell positions that are a loss, replace them with similar but not identical securities, and then at the end of the day, hopefully you have the same returns as the index. And people are very sophisticated with this. It is very, very close to the index. So as far as the benefits of doing this go, there are benefits. Now, Vanguard is one of the firms that does direct indexing or tax loss harvesting, so they're definitely an interested party in this. But one of their studies, which if you go to my blog, I've linked to, is that they estimate the annual value of tax loss harvesting to be 0.47 to 1.27% per year. And there's a few rules kind of, around exactly what they're doing. But if you think about it, that benefit comes from two places. It comes from reducing and eliminating capital gains in those early years, and it comes from those ordinary deductions and reinvesting those tax savings. So if you get a $3,000 ordinary deduction, you're at the highest federal tax bracket of 37%. That's going to be worth $1,110 per year. If you reinvest that, you're going to wind up at a better place. But what you can see here in this chart is, remember I said that the benefits start to really kind of minimize in year 10 to 15? You can see it in this chart. Those benefits really flatline in years 10 to 15. And it's something that, without you actually can't avoid if you do it a certain way. One of the ways to avoid it is by continuing to deposit amounts into the portfolio so that there's always fresh money coming in. But there are benefits to doing this over time, which the Vanguard study shows here. What I want to talk about mainly, though, is that's what anybody can use, right? If you just have an investment account with $1 million, you can get some additional tax benefits. However, if you're a business owner, there are additional sources of capital gains that can be offset. And there's three main ones. If you own a pass-through entity, think LLC, S corp, partnership, what will happen is you probably have some equipment, some business property, whatever it may be. Those assets, what they do is when you sell them, they flow through, just like your business income to your personal return. They flow through as capital gains, which can be offset by your tax loss harvesting account. Now, there are certain rules around that. If you've depreciated it, that depreciation has to be recaptured first. It can't be offset, but any appreciation past that can. Now, secondly, and this is the big one, this is the main thing I wanted to talk about today because the biggest event in most business owners' life, outside of getting married and having kids, is when you sell your business. There's a lot of stress, it's complicated, but it's something you can typically plan around and ahead for because you kind of have an idea when you're getting to the point when you're ready to sell. Business gains, with some exceptions, are subject to being offset by tax loss harvesting, so you can see where I'm going and see what we can combine here. But as I mentioned, not all parts of a business sale may be offset. There are items in business sales that are subject to ordinary income tax. I mentioned one a minute ago, depreciation recapture. If you've depreciated some business equipment that's going to be sold, that'll need to be recaptured first, and it's not going to be able to be offset by capital gains. Other ones are inventory and accounts receivable. Those are all things that can't be offset by capital gains because they're considered ordinary income tax items. There's definitely more, and when you want to talk about a sophisticated, complex thing, as far as taxes go, selling a business is one. So don't take this as the be all end all. Talk to your tax advisor if you're contemplating this. However, if you have parts of your business which are capital gains, goodwill, if you're selling the equity of the business, those will qualify. They can be offset by tax loss harvesting. And this is something where you can use those gains and those losses to offset. However, if you think about it, your business is your largest asset. It's going to take some planning ahead. So, as far as timing goes, you're going to want to plan 1 or 2 or even 3 years ahead to maximize those tax losses because if you only have 1 year, well, what if the index is up and all stocks are up in the year you sell the business? You're not going to get much in the way of tax loss harvesting. It'll be good to be invested, but you're not going to offset the taxes on your business. So there's a few things you can do. One of the things that I like to say is, well, if you're going to sell your business in November or December and you want to use this strategy, why don't you push it to January? If you push it to January, then you have a full year to offset using tax loss harvesting instead of just 2 months, right? So there's definitely some timing considerations, and this is why I talk about planning being the most important. If you're just looking at the sale of your business without the tax implications considered, or if you're just looking at the tax implications without looking at the sale of the business, you're going to miss some of that. So let's look at an example. These are numbers I have completely made up as far as numbers go, right? Your business, your life will never match up to this. This is why it's general information. But let's go through this because I think it's illustrative of how this can work. Let's say you come to me like, hey, Patrick, we got 3 years. Let's plan like I'm going to sell my business in 3 years. We'll say, great, okay, let's look at the tax loss harvesting strategy to see how it could help you. If you look at this, the sale price in this scenario is $5 million. Your basis is $1 million, which means you're going to have gains of $4 million. I'm in Georgia. State income tax rate is 5.49%, which means the tax rate on the sale would be 25.49%. If you had an investment account of $5 million, which we'll be using for this scenario, you could invest it in a tax loss harvesting strategy. And not everybody's going to have $5 million handy, but if you start planning ahead, you can build that tax loss harvesting strategy up and maybe not get all the way to the sales price of your business, but maybe you get a substantial portion of it invested there. So what do these tax loss harvesting strategies do? These are just some numbers I've taken from a couple of different sources. They are, like I said, completely random and hypothetical because years 1, 2, and 3 here in the basic systematic tax loss harvesting strategy is 17%, 6%, 4%. That's a total of 27% of what you invested being generated as a capital loss. The enhanced loss scenario is a tax loss harvesting strategy that adds a few layers to it. It's a little more complicated. It has some higher minimums, but you can see that it results in more like 58% in losses over the first 3 years. So it's got a significant improvement over the systematic loss version. But like I said, whatever the market looks like when you're selling your business is going to govern how many losses can be generated. If it's in a bad market, you probably have much higher losses, but your account's going to be down, so you're not going to feel great about it, but it can help you. So looking at this, there is a lot that you can do here to plan ahead, and let's see what those results look like in this scenario. So if you look at this, in scenario one, if you were to just sell the business, it would result in $3.98 million in net proceeds, so about $1 million in taxes. If you were to use regular tax loss harvesting, you would actually net $4.3 million in net proceeds. So that's about $340,000 in additional proceeds, which is substantial just for planning ahead and doing something you were already going to be doing. You were already going to be investing that money, you just did it a slightly different way. And then finally, if you use the enhanced tax loss harvesting scenario, this would generate almost double the savings, and it would get you up to about $739,000 in additional proceeds, because the capital losses generated over 3 years go from 1.35 million to 2.9 million, which is a huge difference, but it requires planning ahead, and it also requires you planning with your whole life in mind. You may not be able to afford putting such a concentrated amount of your wealth into one investment strategy, which is, to be quite frank, if you're going to try and save taxes but be fully invested in one strategy, it's probably not a good idea for other reasons. You don't want to be that heavily invested in one strategy. But when you look at this, you plan ahead and you put a tax plan together that kind of, takes into account all of these items, you can achieve some positive results. Now, as I've mentioned over and over again, these projections are hypothetical, they're non-guaranteed, and the actual performance of tax loss harvesting programs will be reliant upon market conditions at the time of investment. So these are ideas that if you plan ahead, you manage the timing of it, and oh, by the way, if you have like an installment sale going on, think about how much more time that gives you to generate those losses, right? Instead of having all those gains in 1 year, what if you have them spread over 4, 5, 10 years? You're going to be able to offset a ton of gains. So all of those items matter to you. And I love this tool because there are a lot of ways to offset taxes on the sale of a business. However, tax loss harvesting is a versatile tool that you could already be using for other reasons. And the reason I love it so much is that it's black and white law. There are a lot of aggressive business sale tax strategies out there. And there are a lot of them that I'm not comfortable with. When you're thinking about selling a business, you don't want to have a cloud hanging over you for the rest of your life. Tax loss harvesting is about as vanilla as it gets. There are people doing complicated things out there like that enhanced strategy I discussed, but it's black and white letter law. It's very uncomplicated. The implementation can be complicated, but it's not something you're going to have to worry about, oh man, is the IRS going to come try and find me? It's something that does work for everyone, and it's something that business owners especially can benefit from. And when I say work for everyone, I don't mean that it's right for everyone. I do mean that tax loss harvesting is not some specific niche strategy that you have to have a certain amount of money to invest in. However, business owners specifically, I believe, upon the sale of a business, can benefit from this the most. And as I've said over and over again, doing this on its own could be good, no guarantee, but doing it as part of a larger plan that looks at your entire life is the best way to do it. So if you have any questions, feel free to reach out, but I hope you found this enjoyable. And if you want to read the blog that has, some more links to like the Vanguard study and a few others, feel free to check it out on our website. But I appreciate the time and, hey, I hope you enjoyed it. All right, bye-bye.